to get started in the world of investing. Part 2. How do I buy a share? How do you acquire a share? It's not as straightforward as visiting apple.com or buy and purchasing a share. Not exactly. Brokers are needed instead. Back then, you'd contact a stockbroker and say, "Hey Bob, I want to buy Apple shares." Bob enters into his computer or paper order. You'd hold Apple shares. Thanks to internet brokers, we no longer need to speak to Bob. You create an online broker account to acquire firm shares. Each nation has its brokers, which is unpleasant because a country's internet broker must follow a gazillion laws. The UK method is distinct from the US, Canada, Germany, etc. Most UK banks provide online brokerages. Most bank accounts allow you to start an online investing account. The UI is clumsy. It's retro. Online brokers are typically preferable. In the UK, some use Charles Stanley Direct and Vanguard, but we need to know a few things before opening an account. How do I decide which shares to buy? How do I choose which stocks to buy? You don't want to decide which supplies to purchase, not individual shares. We were talking about why individual stock investing isn't a bright idea. Particular stock investing is dangerous. If you invest in Apple, it'll probably be around in 10 years. Historically, people liked many businesses. This is incredible. Invest in this. The business failed, so buying individual stocks exposes you to an additional risk. Even though Amazon expanded 10 times in the past 10 years, so it'll do the same for 10 years. That's future gazing. Past performance doesn't predict future success. Most people advise novices not to buy individual stocks. Buy index funds. Most people favorite YouTuber Graham Stephan agrees. He believes index funds are the smartest, safest, and simplest long-term investing plan. What's an index fund? 8. What is an index fund? Let's start with the fund bit of the index portion. Multiple investors invest in the same fund. Thus, they pool their money. The fund has a manager. Fund managers choose which firms to invest in. Say I managed a Gringotts fund, and 100 individuals from my audience invested. I may say, okay, the Gringotts fund, now that we have 100 people's money, is 100 million. Everyone contributed 1 million. Therefore, I have 100 million. 20% in Apple, 10% each in Facebook, Amazon, Tesla, and Netflix. 10% in J&J, etc. You don't have to worry because you trust my fund Gringotts and me to handle your money. The fund does well because the values of stocks and shares rise, and I receive a 1% or 2% management fee. I make a lot of money because I earn 1% or 2% of the $100 million I manage. And you don't have to buy stocks. You trust me to do it like an expert. Investing in index funds is simple. How can novices know which firm to invest in? Balance sheet reading. What should I do? Investing in an index fund eliminates such concerns. Index funds provide diversity. S&P 500 firms are diverse. So, you do not wholly depend on tech, energy, apparel, etc. to create money. You're well diverse in US firms. Indices have modest costs because it's not an actual human determining what to invest in and performing all this research. A computer algorithm allocates your money based on index fund components. Low fees. Even a slight rise in prices can drastically affect your financial upside when investing long-term. An index fund with a 0.1% cost is better than an actively managed fund with a 1% fee because the long-term difference is huge. Historically, relatively few funds have consistently outperformed the market, i.e., the index. Warren Buffett believes that if you gave him £100,000 to invest right now, he'd buy the S&P 500 index fund. Buffett challenged hedge funds to beat the market in 2008. He stated hedge funds are useless since they charge too much and don't obtain the promised profits. Buffett made a 10-year wager with Proteg Partners LLC that the index fund would beat the actively managed fund. He won the bet and handed money to charity. This shows that actively managed funds can't beat the market. Nobody can foretell the future market. If you ride the index, you're wagering on the whole market rather than thinking, I've got some fantastic insight into which 10 stocks will outperform the market. Instead of individual equities, ride the market. We've solved the issue of picking equities to buy investing in index funds. Next, individuals ask about stock risk. Isn't investing risky? Ninth point. The standard argument is, okay, this stock trading. My uncle Tom Cobley invested heavily in the stock market. He lost money. My parents say the stock market investment is hazardous, and I shouldn't do it. Investing in real estate is safe. That's how most people see stock investment. There's also the fear of losing everything. Let's discuss. You lose money if you purchase something and sell it for less than you paid. Say you bought a property for £300,000. Brexit comes and housing values drop. Your home's value is now £250,000. If you sell then, you've lost £50,000. Buying a stock at a given price and selling it for less is the only way to lose money in stores. Consider buying Apple shares on February 18, 2020. Say you purchased one share for $79.75 because this is your first time investing. You are constantly checking Apple's stock price to see whether you've earned money. And frustratingly, stock is dropping in the coming days and weeks. You gave up on March 18, 2020. I'll sell my one Apple stake to avoid losing everything. It was $61.67. Since you purchased it for $79 in February and sold it for $61 in March, you lost $18. You think I've lost 20% of my investment? Stock market nonsense. I'm done with the stock market. This isn't very pleasant. Apple's stock price in March was $57.31, but if you hung onto it, what is it today? October 8, Apple is $114.96. You'd make a lot of money if you waited a few months. In 8 months, it would have gone from $79 to $115. Good game. Real estate and equities are long-term investments. Don't invest the money you need in stocks and shares within 5 years. Many would make it 10 years. If you purchase a property as an investment and its price drops, it would be unwise to sell it unless you are urgent for cash because catastrophic has occurred. If you had kept them home, you would have gained more money in the long run since house values usually go up, as does the stock market. This is a contentious proposition. Long term, the stock market usually goes up. I'll produce a video explaining why later, but for now, take my word. If the market crashes to zero, you'll lose all your money. Yes, but if the US stock market plummeted to zero, the top 500 firms including Apple, Google, Microsoft, and Facebook were annihilated overnight. The stock market collapsed. The globe would be in a massive catastrophe, and you'd have more significant worries than your Vanguard portfolio worth. In that apocalyptic scenario, money has no value since the stock market has fallen. Therefore, you'd use it to wipe your bum. It's unthinkable that the world economy would be so bad that every firm goes bankrupt. Again, I'm not a financial counselor. It's not financial advice, but assuming I might lose all my money in stocks and shares is unreasonable. Diversified, you can't lose it all. You bought MySpace in 2000 and it crashed. You lost all your money because they had no money. But if you invest in the top 500 firms in the US, the top 500 companies in the globe, or the top 100 companies in the UK, it's vanishingly unlikely you'll lose your money. We shouldn't even consider that danger. Investing in the stock market is dangerous in the short term. But if you invest in the long term, the market will always go up and you will always make more money if you don't pull money out at inappropriate periods. We've established that investing in equities and index funds is a solid idea. When should I get started? When should you begin? What age? Start too soon? If not, when? Here's an easy solution. Investing advice generally agrees with most of us. Start investing ASAP. Age is irrelevant. No age matters. Investing early is best. Wise financial advice has 3 cautions. First, pay off any high-interest debt, such as credit cards, because compounding profits and loses. Pay it off as quickly as feasible if your 6% credit card debt eats into your monthly income. Second, create an emergency fund. People say your emergency fund should include 3 to 6 months of living costs in cash so that if you lose your job or have a medical emergency and you're not in the UK where medical care is free, or the US, you have money. You don't have to sell investments. Third, don't invest money you'll need within 3 to 5 years. Say you're 24 and recently got your first job. You want to purchase a property but need a deposit. No one can be timing the market, so avoid the S&P 500 and other equities. Nobody knows whether tomorrow's market will tumble. Long term, the stock market rises, but if you need to purchase a home next year, there's no assurance your money will be worth the same or more. Those two prerequisites must be satisfied. First, you have no high interest debt. You have an emergency fund. You don't expect a considerable cost in the next several years. Everyone should invest then. I believe that age doesn't matter. On the trading floor, they claim you won't regret investing. Compounding is to blame. Money compounded the longer it's in the stock market. It's big. People have estimated that investing at 20 versus 25 or 30 substantially impacts your bottom line. After seeing this video and hearing about investing, you should start investing if these 3 requirements are satisfied. We're close. At point 11, we responded, okay, you sold me on index funds. All 3 are true. I have no high interest debt. I'm self-sufficient or a student. My parents are my emergency fund, so I won't purchase a home or anything significant for 3 years. I hope you liked and learned something from today's video. If you want to keep improving and being inspired, subscribe and press the bell button to be alerted whenever we upload a video. This has been Market Profits Institute.